In this episode of Metal Matters, Helen Amos is joined by BMO's chief economist, Doug Porter, to discuss the impact of big macro shifts on the metals and mining space. They talk everything from rate cuts, the US dollar, AI, de-dollarization, global trade, and emerging market development.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
Welcome back for another Metal Matters podcast. There's been a lot to keep us busy in the metals markets over the last few weeks. We had the big correction in gold over the second half of October, followed by a bit of a bounce back. And then we've had the lags in US economic data releases and then the falling odds of a December rate cut. These have been, I would say, clouding the near-term outlook for precious metals a bit. Now with copper, prices briefly touched a record high, just shy of 11,200 in late October. But prices have retraced a little bit. And aluminium's been in the headlines with prices recently touching 3-year highs. And for a few weeks was actually outperforming copper. And on China, we've had the much anticipated 5-year plan being signed off at the fourth plenum. And that talks a lot about the importance of consumption and of maintaining strong links for trade and outbound investment. Now, the latest data does show a continued slowdown in fixed asset investment and industrial production in October, and weaker export growth too. And that is seeding some concerns in the market, I would say, about the health of China's economy and also raising questions about possible stimulus measures that the government might take. Now, for this week's episode, we're going to focus on the macro. And I'm very lucky to have BMO's own chief economist here with me today, Doug Porter, who is joining me live from Toronto. Welcome, Doug.
Oh, thank you, Helen. Thanks for having me. It's a pleasure to join you today.
So, Doug, I wanted to bring you in because when we think about how metals prices can move from here, we broadly look at macro and micro drivers. And the micro, of course, being the commodity-specific supply-demand stories, which for us as analysts, I'd say occupies a huge amount of thinking time. But when we zoom out and look at the really big swings and cycles over the years for commodity prices, really this tends to be more of a macro-driven story. And I think there are a few separate strands to this that I want to explore with you a bit today. First is, the impact that government monetary and fiscal policy can have on metals demand. Second is the US dollar itself, and that was a big theme over the first half of this year that provided a lot of support to metals prices. And then third is the broader global metals demand cycle, which has traditionally really been linked to emerging market development. So, why don't we start then with the first point? Now, how are you thinking about the pathway from here for the Fed funds rate into the end of this year and into 2026? I mean, it seems like we're seeing enough weakness now in economic data to support further cuts, albeit we've had quite a lot of gaps in data over the shutdown. But what would you say are the risks and considerations around the rate cutting path?
Yeah, and thanks, Helen. So first of all, of course, the market has very much changed their view on the Fed over the short term, largely because of just the resiliency of the economy. We've seen pricing on December, for instance, go from, almost being seen as a sure thing that the Fed was going to cut to being, 50-50, maybe even a little bit below that. We have been saying for a while that we thought they would cut again in December. We're sticking to that for now. Of course, we're going to get a rush of data between here and December the 10th. And because the market is so evenly split, each one of these data points are really going to matter here. It could, of course, tip it one way or t'other, but we are still leaning to the view that with the underlying slowdown that we've seen in employment in particular, we do think some of that is going to feed into some of the spending numbers that we will get in the next couple of weeks. And overall, we think that'll be just enough to tip the balance into what could be a bit of a hawkish cut. In other words, they will go ahead and cut, but then signal that things are going to slow down in 2026. Looking a little bit beyond December, we're of the view that there's going to be 3 more cuts next year. So we're a little bit more than what the market, not we very rarely will deviate too much from market pricing, but we have been a bit on the dovish side. If it was just simply a matter of, what exactly are the macro fundamentals, I'd probably be a bit closer in line with the market or even a little bit less. But we do have this X factor that we know we're going to have a new Fed chair by May, if not earlier. And we know that the administration is trying to lean in a more dovish direction. And while the Fed chair is just one vote, we know we've got another Fed president who just resigned recently. We do think the balance is going to tip a little bit to the dovish side in terms of the new appointments. And while that might not make a huge difference, it might be the difference between where the market's pricing and where we are pricing. So I prefer to be on the dovish side of the market over the next year.
Sure. And, this comes up a lot with investors. And I'd say, the view of further rate cuts into next year, which is what a lot of investors are holding in their minds, that certainly would be quite supportive of commodities, but particularly, precious metals, particularly gold. One thing related to that, though, is, we had our London Metal Exchange seminar last month, and we put a poll out to the audience, and we asked the audience, what is your biggest concern for metals prices? And the thing that came up very clearly, number one, was that there was going to be some sort of delayed effect of tariffs on the global economy. So I'm putting this question in because it's related to rate cuts as well. And obviously that for a long time now has been feeding the sense that inflation's going to stay quite sticky, which could create more of, I guess, like a dilemma for Fed officials when it comes to rate cut decisions. But can I just ask you, do you think that the US and in fact the global economy has fully felt the effects of tariffs now? Or is it just a matter of the can keeps being kicked down the road and we're gonna feel it all next year? What's your view on that, Doug?
I think it's somewhere in between. So in other words, I do think that there is still a little bit more to go. We've definitely seen very little pass through, especially to the U.S. consumer. But the full extent to which it's passed through will ultimately be driven by, well, how long or how strong is the underlying consumer over the next year. And we do think things will fade a little bit in 2026, just in terms of underlying retail sales. So we don't think there's going to be a lot of room to fully pass on the price increases. Look, there's not a lot I agree with the president on necessarily when it comes to economics, but one thing I do agree is that the U.S. is basically a price maker, not a price taker. And I was always skeptical of the extent to which the full freight of the tariffs were going to be passed on to the U.S. consumer. So while I do see a bit more, I'm not particularly worried that there's going to be a huge snap in U.S. inflation next year, snap higher.
Yeah.
We think it stays sticky, but not. We've actually got inflation a little bit lower next year than this year.
Yeah, that's a really interesting phrase, like price maker, not price taker. I guess by that, do you mean that either the prices get absorbed or that actually there's alternative, lower cost alternatives that come into the mix to offset some of the inflationary effects? Is that what you think?
Yeah, basically, so let's think of, say, the auto industry. It's incredibly competitive. You've got suppliers from all over the world, including from the U.S. It is really difficult for one supplier to unilaterally raise their prices if tariffs go up, if not everyone else is doing it. And and that's one area where we've really seen precious little pass through to the U.S. consumer. Now it's different for say an agricultural good, and that's why we've seen the administration fairly recently back off on some of those tariffs on agricultural goods, because the consumer really was bearing the weight there. So, in a way, by the way, that's a really important development that the administration has backed off on agricultural tariffs, because it shows they don't want the consumer to feel too much pain.
Yeah. I mean, so that kind of leads on to the next question, really, and perhaps you've kind of answered it a little bit already. You said that you do actually think that inflation's going to continue to cool a bit into next year, but what if we've got rate cuts and inflation cooling, but maybe staying quite elevated relative to history? What does that imply for real rates? Because that tends to be the thing that we all look at, particularly when we're looking at gold, because apart from the last few years anyway, it tends to have quite a clean negative correlation to real rates. So do you think we could be looking at a move back into negative real rates anytime soon, in your view?
For the U.S., I don't think so. In fact, I think the Fed will be watching this really carefully. A number of them, of course, are focused laser-like on real rates. So our call on Fed funds, for instance, would get us to around 3% or just a little bit below, and we happen to believe that headline in core inflation will be a tad below that. If you think back to the olden days before COVID, we would have thought of real rates, very modest real rates as being sustainable. So, for instance, something like about 0.5% above inflation. I think that's where we ultimately settle out, is on very mildly positive real rates, at least in the U.S.
And then, this is all kind of like closely wrapped up with the big topic of, actually more of a fiscal topic and this growing narrative around the sustainability of US government debt. And then I guess, there's a sense that the only way, or one of the ways that we're perhaps going to deal with these very high levels of government debt is by keeping inflation high and interest rates low. But I guess it's a very mainstream topic, but it's not the first time we've been worried about the levels of government debt, is it? This is not new, but when does it really start to become a problem in your view? And why is everyone now seemingly tuning into it more?
I think it's a combination on your last question. I think it's a combination of some of the concerns we've had out of places like the UK and now France. And the fact that the one big beautiful bill really did nothing to bring down the deficit longer term. I think this is why it's coalesced. And of course, U.S., depending on which measure you look at, but U.S. Debt to GDP is now close to 100% for the first time since the Second World War. I think all these things have sort of come together. I find myself in a bit of an interesting position because coming out of the pandemic, I was actually pounding the table that, look, this is one thing that's really changed, that we're really going to have a serious fiscal issue here coming out of the pandemic. We've got, tough demographics in much of the Western world. We've got, real interest rates, longer term interest rates that have gone from almost zero to now, as I said before, pretty clearly positive. And, finances around the world took a really heavy hit during COVID. So all those three things together, left finances and government finances in a really tough position. Having said that, I'm not as negative on the one big beautiful bill. Keep in mind all that did was lock in tax cuts that were already in place, and it did not take account of tariff revenue. So I will say I think a really big deal here is what does happen to that tariff revenue. In recent days and weeks, we've heard the president talking about handing out $2,000 checks to all low and medium income earners. Well, if he does that, if that actually does become law, then I would be much more worried about the fiscal situation. As much as I hate tariffs, hate the U.S. tariffs, they are bringing in very substantial revenue. The run rate right now is about $400 billion a year. That would actually be a nice step in the right direction to bring down the budget deficit. Even though, as I said, as an economist, I don't like them, they are helping to moderate the U.S. deficit, and they were not taken into account in the one big beautiful bill.
No, that's certainly a good point. So you're saying, in a way, there could well be a realistic pathway that the level of debt, or the burden of debt anyway, in terms of payments, actually starts to ease because of the impact of the tariff revenue?
A little bit, yes. Now, we're starting out in a really bad place. I mean, the U.S. budget deficit's about 6% of GDP. That's not sustainable. They do have to bring it down. Besson has talked about getting it down to around 3% of GDP ultimately, and I think that's the goal that the U.S. should be aiming at.
And like the other angle that we think about, particularly in metals, minerals, and critical minerals, is on the investment side. So a big part of the bill was, to massively increase spending in areas, particularly like defense. And that's trickling now through into, actually, we're seeing quite a lot of momentum now in US government investments into critical minerals and projects. So, to what extent, in your eyes, can investment itself be a lever to, obviously, initially it potentially puts strain on deficits, but down the line, to what extent do you see it as being like a positive lever for the economy?
Yeah, and if we broaden it out and think of the the overall spending on AI and everything related to it, the backbone of AI, we estimate that that's accounted for more than half the growth in the U.S. economy this year. And of course, this has got nothing to do with administration policies. That boom was well underway even before this year, and it's gathered steam even as we speak. It's gathering steam. That to me is actually even a bigger driver than anything that was included in the in the one big beautiful bill this year. I think that may have helped push the stone that was already rolling down the hill. But to me, we would have had a very formidable rise in investment in any event because of everything related to AI. And I do think that has some room to run here. Even if a lot of us have misgivings about some of the valuations in the equity market on that front, I do think there is just this tidal wave of investment that's we're really just in the middle of.
Yeah, I was going to say that definitely provokes questions as you're talking about AI and CapEx. That's certainly been in the headlines in the last few weeks about valuations and CapEx. One thing that I read this morning, which kind of calmed me a little bit, I guess, is the fact that traditionally, like big stock market corrections have happened when there's been a tightening cycle, but we're certainly not moving into that. We're moving into an easing cycle. So should that calm our nerves a little bit?
I think it should, but that doesn't, of course, rule out that we could still have a correction, even without the Fed necessarily getting in play. Actually, my colleague Robert Kavcik just recently wrote a piece on that, which talked exactly about that point. I think the point he was making is true bear markets we've seen have been preceded by Fed tightening, but you could have a correction, which frankly might be healthy at this point. Yes, independent of the Fed.
Yeah, indeed. Okay, well that's fantastic. Related to that, let's stay on the US. I mean, obviously, it's so important, and the US dollar, because obviously rate cutting feeds into the dollar, and then also this topic of debt levels. We had this big weakening in the dollar index over the first half of 2025, and it came from quite a high base, admittedly, but over most of the first half of the year, we saw a weakening in, like, say, the DXY dollar index, and that ends up being a real nice tailwind for commodity prices. And obviously, there's I always think about like two angles to that. One is the fact that it makes commodities cheaper in local currency terms, arguably like boosting demand. And then related to the fact that producer currency strengthening, it pushes up the cost curves of the commodities in dollar terms, and that also lends support to prices. But that weakening trend sort of seemed to come to an abrupt end sometime around the summer. And if anything, at periods over the last few weeks, it looks like the dollar index has been strengthening again, which definitely kind of potentially threatens a little bit metals prices. Firstly, can you just recap briefly, what was it that pushed the dollar lower in the first place over the first half of the year? And then, do you think that the cycle is turning now? Is this just a bit of a pause? Should we think that the weakening trend should resume at one point?
So I'll start with our core view, and our core view is that we believe we're in a short-term cyclical downtrend in the U.S. dollar. I do believe this is a pause. We have the dollar weakening somewhat in 2026, and part of that just goes back to my earlier view that we think if the market's going to be a little bit wrong on the Fed, it's that it'll be a bit more dovish than the market currently expects. Partly again because of the makeup of the Fed, and we also do think U.S. inflation will remain or will moderate a bit next year. I will stress that I am not a long-term bear on the U.S. dollar. When we get beyond this cyclical softening in the dollar, I would revert back to being relatively bullish on the U.S. dollar when we get beyond 2026. Just to answer the other part of your question in terms of what caused the big drop in the dollar earlier this year, I do think it was just the reaction to the trade war. If you dial it back a bit more than a year ago, of course, part of the the bigger Trump trade was one of the portions of that was supposed to be a stronger dollar. And I think what caught the market completely by surprise, through the early part of this year in the spring was how the trade war was put up front and center in terms of the Trump administration 2.0 was the first priority, which, and let's face it, that's the part of the administration's policies that the market does not love. And when you think about the U.S. basically declaring trade war on the entire world, that was not great for the US dollar because you had a lot of economies basically openly shunning or talking about shunning the US dollar. I think what happened through the summer and why the currency's made a bit of a comeback, I think cooler heads have prevailed here. We've all stood back and realized, well, that's not really that big of a deal. There are a number of economies that were trying to move off the US dollar in any event, like China, for
Hmm.
instance. So not really that much changed. And if you were to go to the economic textbooks and say, well, how should the US dollar respond if the US were to impose a 15% tariff on everyone and basically nobody retaliated? Logic would tell you that the US dollar should actually strengthen, all else equal.
Yeah.
So our call on the dollar really is a monetary policy view over the next 12 months. But thereafter, I'm a bit more bullish on the US dollar.
Yeah, and just to pick up on that, because it relates to the next topic of de-dollarization, which is, I'm separating that out from the value of the dollar itself. But you say you're actually bullish on the dollar from beyond 2026. Like, what is that related to the productivity argument?
Yeah, a lot of it is. I just, while everybody's got their issues, I think the U.S. probably has the fewest issues when we look at the major economies, and I do think that we have seen that they have the best growth fundamentals among the major Western economies, anyways. Whether it's demographics or productivity, the combination of them are more positive for the U.S. And even the earlier fiscal concerns we were talking about. Well, of course, compared to everyone else, the U.S. is not in particularly tough shape. In fact, I'd say they're more or less middle of the pack. So. While it is a bit of a near-term concern, longer term, I'm not. I don't think the fiscal issues are a killer for the U.S. dollar.
Yeah, and it's a good point. It's not just a US issue, is it? I mean, it's certainly present over here in Europe too, Japan. Um,
Absolutely.
what about de-dollarization as a theme, though? It's been the big buzzword in recent years, particularly in the circles that talk about gold. And there's two aspects to it, at least from what I can see, but you might see others. One is the push from central banks to diversify their reserve assets, meaning potentially a lower share from the dollar, and a higher share from gold. And this seemed to accelerate sharply, especially after the Russia-Ukraine conflict started in 2022, for obvious reasons. And then there's the fact that, the other aspect of de-dollarization, I suppose, is the fact that other currencies of trade are emerging or gaining greater prominence. So particularly the RMB. Data would suggest it's gaining a greater share in terms of global settlements. So what does de-dollarization mean to you?
So I will tip my hand and tell you that I've been through many, many cycles. I've actually been in the business since the mid 1980s, and I've seen a lot of huge swings in the dollars over the years. So I see nothing as being irreversible. And by the way, when I talk about I'm relatively bullish on the dollar when we get out into the medium term. I'm thinking in a 3 to 5 year period. If we go much further on, 10 years, I do think there is some teeth to de-dollarization. Obviously, as I mentioned earlier, we've got a lot of economies that are actively trying to move away from the dollar, and ultimately, I do see its weight somewhat fading. If we look out 5 to 10 years, I think that will be a minor force or a medium force on the currency longer term. But as I said, there have been many ebbs and flows over the years. I I still believe, many decades from now, the dollar will still be king. Even if its overall role will be somewhat reduced, I think it will still be the dominant currency. I just don't see a realistic uh, substitute for the dollar in anytime soon. Um, and I'm not going to make a call on whether the shift by central banks to gold has run its course, but
Hmm.
I wouldn't be surprised if we've seen the peak in that move for now, and it fades a little bit from here. I wouldn't be shocked.
Yeah, I mean, certainly, just through the appreciation of the gold price itself, by definition, the share of gold in central bank reserves has gone up steeply. But just in volume terms, I mean, just to echo that, we have seen the pace soften a little bit this year. I would say the data suggesting it's down by about 20% year on year, but still very elevated relative to the kind of pre-Russia-Ukraine conflict norms. One thing I've always wondered, and maybe you can give me a hand with this, is that we've talked about de-dollarization and the value of the dollar itself. I mean, does de-dollarization, or rather maybe other currencies or other assets having a little bit more of a prominent role in the global financial economic system, does that necessarily mean kind of long-term downward pressure on the value of the US dollar itself? And I guess the reason why I ask that is that we hear a lot of narrative around the fact that the US wants to or needs to address trade imbalances with other currencies. And one avenue in which that might be achieved is through allowing weakness in the dollar, and with that appreciation of other currencies. And some would even say that China actually long term wants to allow the RMB to appreciate to address its own large trade surplus. So what would you say to that? I mean, lots of questions folded into one there.
Yeah, and I don't think the currency is the answer to solving the U.S. trade deficit. As I said, we've seen some massive moves in the U.S. dollar in the last 40 years, both stronger and weaker, and it has not necessarily moved the needle in a big way on the trade deficit. To me, it's really driven more fundamentally by I would say the lack of savings in the U.S. and yes, excess savings, and especially in Asia. And that cannot be fundamentally shifted by moves in the currencies. It can help at the margin. If we were to have, say, a 20% decline in the dollar, it would probably help narrow the U.S. trade deficit somewhat, but it would not, quote, fix it. The other point you make, and I think what you're driving at is, as the much more interest in crypto and now stable coins, does that really change the outlook on the US dollar? I would point out that this tremendous rise in gold and Bitcoin that we've seen in, say, the last 4 or 5 years actually came at a time when the US dollar generally has been stronger. So you can get both apparently at the same time. That old correlation hasn't necessarily held up exactly this cycle. The one thing to point out, and one reason why I can't get that bearish on the US dollar, is insofar as stable coins really do take off, that could be a source of support for the US dollar. Now, what we're seeing is other countries are now, even here in Canada, in our recent budget, the government basically backed a move to create our own stable coin here in Canada, because I think they're concerned about ultimately the flows going to the US dollar if it's the only game in town when it comes to, say, a digital central bank currency or stable coins. So this is why I think other countries are now going to try to get in the game as well, so that all the money doesn't flow immediately to US dollars, which when you think about what backs a stable coin, well, most of the ones that are out there, it's backed by something like UST bills. And so if you don't get competitors from Canada, Europe, Japan, then, a move to stable coins could actually strengthen the US dollar.
Yeah, no, that's a fair point. And I have to say, like, the stablecoin space is moving at such a rapid pace. Every day I'll look on my newsfeed and there's some other new stablecoin has been launched. No doubt there is going to be a China version of stablecoin too, as well as, digital RMB. Whilst we're on emerging markets now, and, I always like to, kind of remind everyone, I suppose, that, really emerging market development has always been the bedrock of metals demand, from the beginning of when China started to take off in the early 2000s, and it's still true today. It's just that the composition of it is a bit more evenly distributed. China's still there, but it's exporting a lot of metals as well in the form of products, and that's meeting demand from other emerging markets. And I think we all get quite a lot. Our focus time goes on the US and tariffs and US policy, but I think it's easy to forget what's going on in the rest of the world. When I look at the pie of metals demand today, I would say, like, especially the big ones like copper, aluminium, iron ore, the vast majority of that demand essentially still comes from traditional applications like the grid, construction, infrastructure, transportation, equipment and goods. And really, it's emerging market development that is the driver of this. So, and when I think about that, it seems like emerging market growth is having a good moment. I wonder to what extent is the pathway for the US dollar a bit of a tailwind for that?
Probably a little less so than just how the overall tariff scenario plays out and how the global economy deals with it. And I have to say, if we stand back and really, maybe we should have started with this, if we stand back and really look at how the global economy has performed through this period of intense turmoil around trade, I have to say I have been more than pleasantly surprised at how well the global economy has managed through this year. I mean, it's going to end up being a below average year for the global economy, but not nearly as dire as things may have looked, say back in March and April. For instance, we're still tracking essentially global growth of 3%. This year, or even a little bit above, and we think it's going to be 3% on the button in 2026. To me, by the way, an average year for global growth would be about 3.25% to 3.5%. And, the U.S. is part of that story, but certainly emerging markets are a big part too. And I mean, to me, the single most surprising, well, one of the most surprising numbers I've seen this year is how well China's exports have hung in there. Even with a deep decline to the U.S., we've seen big increases to the rest of the world. And, the rest of the world is basically moving on and getting past the U.S. trade war, and that is very impressive and I think bullish for metals price. And then when you load on top, of course, the other big story besides trade this year has been the absolute boom, and I think boom is understating it, and everything related to AI. And of course, you talked about grid. Well, there is a build out in the U.S. grid like the likes of which I haven't seen in my career. Electricity used to be incredibly sleepy, and this year it's not sleepy.
Yeah, no, absolutely. And you're right. I mean, that's been such a big surprise. And I think I was looking at a recent World Trade Organization update on projections for full year trade. And you're heading into the year, I think projections were for like minimal growth, like less than 1% growth in global trade because of the effect of tariffs. But the year is on track for coming in closer to, I think, about 5% growth. And when you look at some of the drivers for that, one of them is AI related trade. But the other thing is just trade within Asia. So emerging markets in Asia. And that's come as a bit of a surprise, and certainly, as you said, probably not what the textbooks would have predicted. I'm just thinking, we're moving, and arguably this shift was happening anyway prior to this latest wave of US tariffs, but we're moving into arguably like a more fragmented world, decoupled world. We're seeing policy-driven shifts in trade, so we're like forcing trade into locations that it doesn't kind of economically naturally want to go into. But could there be, any winners from this? We always think that this is like bad news for everybody, but and I guess I'm potentially what I'm scraping at a little bit is the fact that we're seeing this like real strength in trade within the BRI countries. Does that become somehow like a virtuous circle, and that becomes sort of self-sustaining and actually ends up being quite a strong positive driver for growth in the region?
It may well be, and I still believe that the imposition of tariffs, does throw a bit of sand in the gears of the global economy, and overall, it's been a small net negative for growth. But having said that, clearly there have been some net winners from this, and I think you make a good point that basically so I'm going to use an example close to home. In Canada, some have actually said maybe Mr. Trump has done Canada a big favor longer term. It feels painful now. I mean, the U.S. is by far our biggest market. We are highly dependent on the U.S., but basically it's really it's like a little fire under parts of Canada and different sectors, realizing that it's shaken it out of its complacency. And to some extent, we could be seeing that going on a much broader scale around the world. that, it's really forced a lot of companies, a lot of economies to look for other sources of growth, look elsewhere for trade and not just rely on the U.S. market.
Yeah, I mean, it certainly put the fire under a lot of the metals of the mining sector this year. Before we wrap up, and from my perspective, China is obviously very important. People within the company will hear me talking about China a lot. It certainly feels like from the latest communique we've had from China on their next 5-year plan that they still see, their role in global trade and investment is still very central to their ambitions. They're talking about still, making lots of investments, even though it feels like they've already made a huge amount, but more investments in ports and rail capacity, the creation of these free trade zones. So, it certainly seems from our perspective that China is continuing to see itself, reaching outwards, particularly to the BRI countries, and then playing a vital role in the economic systems there. But before I wrap up, I was going to put a curveball out there, Doug, and ask you, I'm sure you get asked this all the time, but what would you say could be the biggest surprise for us in terms of the economy, be it global or North American, next year? What do you think is going to take us by surprise?
So I would say it would have been a really easy answer if I didn't know that we have a new Fed chair next year that's going to be appointed by the president. But I would have said the one thing to watch out for under normal circumstances is that the Fed could be tightening in 2026. The closest parallel that this cycle I can draw or find is the late 1990s. And of course, what happened in the late 1990s is ultimately the Fed had to tighten because of the runaway boom we had and everything related to the internet at the time. And there are a lot of parallels to late 1990s. It's not perfect by any means. Now, what we might see, if I were to say a surprise, it's not that the Fed is tightening, but the market is starting to look for Fed tightening by 2027. So in other words, we start to see the curve really begin to steepen through next year. And, and ultimately that would mean the dollar makes a turnaround earlier than I had predicted. So you'd start to see the US dollar coming back in 26 just because of this boom in AI that's got a lot of legs to it, I believe.
So just to try and cool things down, I suppose.
Mm-hmm.
Well, I think that certainly would be a big surprise for lots of us in our space, that's for sure. Doug, I think that brings us to the end of the podcast. I want to say a huge thank you again for taking the time to join me on our Metal Matters podcast. It's been an absolute pleasure to talk to you. And I've really enjoyed our quick tour of the big macro themes today. And to our listeners, thank you once again for joining for another episode. And if you have any questions on what we discussed today, feel free to reach out to us.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.